Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest energy updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic. Bringing you updates every day at 9 a.m., noon, and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Imagine a domino line stretching across centuries of financial history. Each domino represents a market, an asset, a system. Push the first one and the rest follow. Sometimes violently, sometimes slowly, until suddenly the whole system jolts. That's what we're seeing right now. First it was oil, then liquefied natural gas, then copper, and now XRP quietly appears in conversations about global financial infrastructure. Let this sink in, ladies and gentlemen. Now, don't mistake this for hype or a prediction of a sudden price explosion. This is a story about patterns, chain reaction, and the subtle rhymes of global markets. And if you pay attention, you'll see it unfolding just as clearly as historians watch the collapse of empires or the rise of global trade networks. Think about it. When Rome fell, it wasn't just militarily defeat. It was a sequence, a disruption of supply lines, inflation, collapse of liquidity, and systems struggling to move wealth efficiently. Financial dominoes have always fallen in sequences, and the same forces are at work today. And today, I want to show you the modern version of the domino line, from energy to commodities, to currencies, leverage, liquidity, and finally the infrastructure that keeps it all from grinding to a halt. But before we break this down, this is not financial advice. This is education, history, and analysis. I want you to always do your own research and make decisions based on your own risk profile. I want to thank you to everyone who likes, subscribes, shares, and comments. These couple of things really do help out the channel and help get this video out to more people. I appreciate everyone. Now let's start with the dominoes almost everyone begins with. Energy. Why energy moves first? Energy has always been the heartbeat of civilizations. Think of the Industrial Revolution. Coal was king. Nations rose and fell based on their ability to mine, transport, and utilize coal. A disruption in coal supplies could grind factories to a halt, cause unemployment spikes, and ripple through global trade. Today, oil and gas play a similar role, just faster and more interconnected, and more leveraged than ever. Oil fuels transportation. Natural gas fuels electricity grids and industry. LNG allows energy to move between continents. And like in the old Silk Road days, shipping corridors and choke points that can make or break economies. Let this sink in, ladies and gentlemen. The Strait of Hormuz, the Suez Canal, the South China Sea. These narrow corridors carry vast amounts of global energy daily. When the routes become risky, the first people to react aren't politicians. They're insurers. Shipping companies cannot move tankers without coverage, and the cargo they carry is worth hundreds of millions of dollars. If insurers raise war risk premiums, suddenly moving oil is far more expensive. And here's a lesson from history. During the Napoleonic Wars, insurance rates for maritime shipping spiked dramatically, long before official blockades were enforced. The economy felt the impact before any armies moved. Markets anticipate risk. Humans always have. And the effect is immediate. Oil prices rise, shipping costs rise, industrial production becomes more expensive, inflation pressure starts building. Even before a headline appears, the first domino has already fallen. I want to talk about the second domino, LNG. Often oil moves, natural gas follows. Consider Europe in 2021-2022. LNG shipments were delayed, gas storage ran low, prices spiked, energy costs became a key driver of inflation. Factories slowed production. Households felt it in heating bills. History repeats itself. During the 1973 oil embargo, the energy storage wasn't just about gas stations, ladies and gentlemen. It caused macroeconomic dominoes, inflation, currency depreciation, unemployment rises, and shifts in global alliances. LNG now plays the same role. Supply chains are global. Once disruption in shipping routes or contracts ripples immediately across multiple continents. Step back. Every spike, every delay, every sudden shortage is a signal. Not hype, just information. Markets respond faster than governments. The earliest responders are always those who price risk. Insurers, traders, those move capital efficiently or are trying to move capital efficiently. I want to talk about copper, the economy's barometer. Copper is often called the metal with a PhD in economics. And that's not exaggeration. Think about ancient civilizations. Rome and Greece mined and transported metals extensively. Copper, tin, silver. They weren't just commodities. They were money and the backbone of infrastructure. Today, copper tells a similar story. It powers construction, electricity, EVs, and tech infrastructure. When copper moves, it's rarely random. It signals shift in production, expectations, supply chain stress, or industrial demand. Imagine the Great Depression. Commodity prices collapsed first, then industries slowed, then currencies faltered, then leverage blew up. Copper is often that early bellwether in modern markets. So when we see oil, LNG, and copper moving sequentially, history reminds us these aren't isolated markets. They're dominoes in a global section. I want to talk about currency pressure in the yen carry trade. Energy and commodity movements eventually pressure currencies. Currencies are the arteries of global finance. Every trade, every investment, every loan interacts with them. Consider Japan's historic low interest rate policy. For decades, it enabled the yen carry trade, a leverage play used globally. Investors borrowed in yen at near zero rates, convert higher yield currencies, and invest elsewhere. History teaches a clear lesson. When leverage builds quietly, the unwind can be catastrophic. I want you to think of the 1997 Asian financial crisis. Capital flowed out of Thailand, Indonesia, and South Korea almost instantly. The carry trade unwound. Liquidity evaporated. Exchange rates gapped. Markets repriced violently. The mechanism today is the same. Rising energy prices, pressure inflation, always. Central banks face dilemmas. Currencies begin moving. Leverage unwinds and liquidity starts to disappear. I want to talk about when liquidity disappears. Liquidity is the hidden oil of financial markets. Even the largest markets rely on confidence. Once stress enters, liquidity can vanish quickly. Think of the 2008 global financial crisis. Mortgage-backed securities seemed like $1 trillion market. But when confidence collapsed, liquidity evaporated. Markets gapped. Banks froze. The plumbing failed. Today, the pattern is identical. The moment leverage exits the system rapidly, liquidity, not price, becomes the story. Stocks don't drift. Currencies don't inch lower. Crypto and digital assets reprice violently. I want to talk about the infrastructure solution, XRP. This is where XRP comes into play. Historically, every financial system has faced plumbing failures. During stress, Roman Empire, coins and bullion didn't move efficiently between provinces. Armies struggled to get paid. In the 19th century, rail networks, money and goods took weeks to cross continents. In 2008, correspondent banking froze liquidity during systematic stress. XRP was designed for this modern bottleneck, rapid settlement, cross-border liquidity, and on-demand capital movement. During stress and moments of stress, infrastructure that moves value fast becomes strategically important. This is vital, not speculation, necessity. This is the most important factor that you guys need to pay attention to. 100% what I just said. Let this sink in. It's vital. Because when I get to the rant later at the end of this video and we tie it all in, I'm going to go over this again. I want to talk about historical parallels. Let's look at some historical parallels that illustrate what we're talking about here, okay? The Napoleonic Wars in shipping, insurance. Merchant ships delayed by war risk caused commodity price swings before armies moved. Very important. 1973, oil embargo. The world learned that energy shocks cascade across multiple sectors. Transport, food, industrial goods, and currencies. 1997, Asian crisis and carry trades. Leverage built in stable times unwound violently once confidence broke. In 2008, GFC. Liquidity evaporated despite large market caps. Price became secondary. The system's plumbing was tested. The European coal shortages, 1917 to 1908. Supply disruptions led to electricity blackouts, industry shutdowns, and social unrest. Centuries before modern markets, yet the mechanisms is identical. Each story reinforces a simple truth. Pressure moves in patterns, and systems that fail to move capital quickly are exposed first. So I want to recap the dominoes I just went over, okay? Step back and observe the pattern forming. Energy disruption. leads to shipping risk and insurance reaction, leads to transport costs and commodity adjustments, leads to inflation pressure builds, leads to currency stress and leverage unwinds, leads to liquidity tightens, leads to financial infrastructure becomes critical. This sequence has repeated for centuries in every market system, ladies and gentlemen, under every financial technology. And today we see the same pattern emerging with modern analogies: oil, LNG, copper, the yen carry trade, and digital infrastructure like XRP. So, ladies and gentlemen, positioning versus reacting. History teaches us this: the smartest actors position, they don't predict exact moments. Roman merchants adjusted trade routes before conflicts escalated. Industries hedged coal and steel supply before inflation hit. Modern institutional investors monitor energy, commodities, and industrial signals. Being early is about recognizing the pattern, not predicting the headline. Now, I want to hear from everyone. Out of all the signals we just discussed, oil, LNG disruptions, copper movements, yen currency shifts, liquidity tightening, which would you watch first if you wanted to anticipate financial stress? Drop your thoughts in the comments. These conversations help everyone understand the bigger picture. Well, ladies and gentlemen, happy Saturday. Sorry it takes me so long to make these videos. Again, there's a lot happening, and all of us live on the phones right now, so it's very hard to get off the phones. So I want to continue, and I just first want to build on. If everyone's new here and you've made it to this part, please do subscribe, like, comment, and if this is your first time watching, because the rants, when you get to the end of the video, we go over everything, and they're building on what the previous rant was in the previous video. So you're going to have to go back to that. Well, ladies and gentlemen, I want to welcome everyone to the most exciting times that we're living in. What a time. And there are people getting cut up like sushi, and there's blood in the streets. But as the wolf, we don't do tricks in the circus. Just as we said there'd be violent repricings, you see that. Just as we said certain scenarios are unfolding, they're unfolding. Ladies and gentlemen, I want to say something, and this is very, very important. With the exception of the war in Yugoslavia in the 90s, we've never really seen regime change from the air. So this is a tough one. I just want to start with that one thought. I want everyone to write that thought down. I want to welcome all the new members of the Crypto Monthly Desk, all the new members of our membership channel. Thank you and welcome. I love chatting with everyone. The most important thing we're going to start with today is this. Russia joins the XRP revolution. Moscow Exchange to launch futures. Moscow Exchange is contemplating cash-settled XRP futures following Russia's regulatory shift. It's massive and a landmark shift for Russia's crypto market. The central bank will formally regulate digital assets trading, fully integrating cryptocurrencies into the national financial system. Let this sink in. It's massive. XRP, a leading cryptocurrency for cross-border payments, will be among the first to benefit from Russia's new regulated crypto framework. The Moscow Exchange, MOEX, plans to launch XRP futures in 2026, alongside Solana, Tron, bringing digital assets under central oversight for both institutional and retail investors. This comes as the CME Group now dominates 75% of the global crypto futures market, with XRP playing a key role in its expansion. Why this is a game changer? Well, future contracts let investors bet on an asset's price at a set date, providing both hedging and growth opportunities. So, by launching XRP futures on MOEX, Russia offers a regulated, transparent avenue for trading digital assets, reflecting a global trend of traditional financial institutions adopting crypto derivatives to gain full exposure without the risk of spot markets. Okay? Moscow Exchange to launch XRP, Solana, and Tron futures. Let this sink in. This marks a pivotal shift for Russia's crypto market. Listing XRP and other major cryptocurrencies on the Moscow Exchange under central bank oversight legitimizes digital assets and signals a strategic push to attract institutional capital. Therefore, Russia's inclusion of XRP, Solana, and Tron highlights a focus on cryptocurrencies with proven utility in payments and decentralized finance. XRP stands out for its rapid settlement times and widespread use in cross-border transactions. So by launching regulated futures, Russia is bridging traditional finance with a growing crypto economy. As the 2026 MOEX launch nears, investors will watch closely. The move could boost crypto adoption, in our opinion, increase trading volumes, and set a benchmark for national other national exchanges, excuse me. For XRP holders and enthusiasts, it signals mainstream recognition of one of the world's largest financial markets, especially as Russia cites an annual crypto turnover of $129 billion and tightens rules, licensing, and investor limits. This is the big thing about this, ladies and gentlemen. Stay with me. Meanwhile, unlicensed crypto exchanges may be blocked as regulators tighten control of the Moscow exchange, targeting $15 billion in annual fees. Ladies and gentlemen, that's massive, massive. I'm going to recap the last 48 hours, that how we see it, and people we've been communicating with family office, funds of funds, and everyone who retains us in any capacity. Also, what's going out to members of the crypto monthly desk in the Patreon. Welcome. And ladies and gentlemen, if you're looking how we capitalize off of this, please come and join us, because I'm going to say something right now. There is so much happening in today's world. The chaos, the chorus of chaos. There's so many places right now to harvest and take advantage. It's raining situations, and raining's alpha. We got a brand new one. The other ones that the whole world is talking about, those are old already. I know you hear it every day, and that's why Intel, and being a financial mercenary, again, we don't care what happens. I want to take advantage of every single situation that's going on, and there is just too many to count of. It's unbelievable. It really, really is, and that's why I'm so excited, because with all the chaos that we get to be a financial mercenary and take advantage of how the powers that be and why they were the remora swimming on next to the apex predators, we get to do what they're doing. We get to take advantage of everything they're taking advantage of, and this is unbelievably awesome. So again, let's get right into this. So, ladies and gentlemen, I'd like you to please return to your seats and buckle your seatbelts. We're about to lose cabin pressure, so stick with me. And at the end of this rant, I will summarize all this. Ladies and gentlemen, the storage clock is ticking. From demand disruption to supply shock in the Strait of Hormuz, from my perspective, the global oil market is walking on a tightrope, and the Strait of Hormuz remains the single most sensitive choke point. Roughly 1/5 of seaborne crude passes through this narrow corridor. Any sustained disruption immediately stalls shipments, limits refinery assets, and slows industrial activity across dependent economies. But the bigger threat isn't just the interruption of shipments, ladies and gentlemen. It's what comes next. If tanker traffic stays halted, producers quickly run out of storage. Once tanks near capacity, wells have no choice but to shut down. Restarting production after a shut-in is far slower than resuming shipments once a transport bottleneck clears. Let this sink in. Going to take the PhD out of PhD. In short, we move from a demand-driven slowdown to a structural supply shock. A recent note from JP Morgan Global Commodities Research underscores this, and everyone on the street is talking about this. None of this is financial advice, our opinion. So if you look at early estimates, suggested Gulf producers had roughly 25 days before storage constraints forced output cuts. 25 days. But revised data reflecting current storage levels at the onset of disruption indicates that the timeline could be considerably shorter. It's massive. This is what we're paying attention. Put that down, write that on your wall. Uneven storage, unequal risk. The average 25-day figure masks significant discrepancies among producers. Storage capacities across the Persian Gulf is far from uniform. Some countries have large buffers, while others are already tight relative to export volumes. Again, this is massive. So according to JP Morgan and a lot of others on the street, Iraq is the most vulnerable. Potential hitting storage limits in just 3 days. Kuwait is also just as exposed, with capacity potentially maxed within 2 weeks. Even these estimates are conservative. Again, this is what everyone's paying attention to. You're going to learn this because we're the remora. You're the remora too. They exclude certain product storage sites and assume minimal use of floating storage. In reality, the margin for continued production is extremely narrow. I want to talk about the supply shock curve. This is massive too. If tanker traffic through Hormuz remains stalled, production cuts could escalate quickly. JP Morgan's modeling suggests by the end of disruption, about 3.3 million barrels per day of crude could be forced offline. By day 15, that number rises towards 3.8. By day 18, it could approach 4.7 million. These figures focus on crude alone, excluding refined products. We're going to get to that later because the refined products are very important. Once tanks fill, the problem shifts from logistics to actual production. Not all storage is created equal. The location of a tank relative to wells or loading terminals matter very much. Storage isn't fully interconnected, so inefficiencies prevent the simple redistribution of oil. When terminals near the coast fill upstream fields must reduce output. Early signs of shut-ins. Some of this is already happening. Reports indicate Iraq has already roughly cut 1.5 million across key fields, including Ramallah, West Quran, and Mazan. Meanwhile, tanker traffic through the straits remains largely frozen. This is massive. Pay attention here. Outside of Iranian vessels, confirmed crossings are virtually non-existent. Not happening right now. There are occasional movements with transponders switched off. For example, Suezmax tanker Polar entered the strait before disabling a signal, but completely shipping companies are avoiding transit entirely. So if you look at political and military options, the most immediate path to reopening this route would be direct government intervention. Pairing naval escorts with war risk insurance is one option, reducing both physical and financial risk for shipping firms. Time is critical. Once producers hit tank capacity, wells shut down, and restarting them later is costly and slow, prolonging supply disruptions even after the corridor reopens. There's escalation risk beyond the strait. The regional security environment remains precarious. The United Arab Emirates recently reported a fire at the Fallujah energy hub after intercepting a drone. The complex hosts multiple refineries and storage facilities and serves as a major export logistic hub. Market reactions immediately. Brent crude went through the roof. Look where it was. It went from 85 all the way to the 90s as traders began pricing in not just delays, but potential production disruptions extended. If attacks extend to tankers, the impact could cascade across multiple export terminals, which they have already. We've seen tankers getting hit, one by missiles, one by water drones. A partial relief valve. Some Gulf producers are attempting to ease the pressure. Saudi Arabia, for instance, is increasing flows through the East-West pipeline to the Red Sea port of Yanbu. The pipeline can move roughly 7 million barrels per day, but prior to the conflict, it operated below capacity, leaving room for some additional throughput. Even full utilization, ladies and gentlemen, however, cannot fully compensate for a full closure of the Strait of Hormuz. The vast majority of Gulf exports remain dependent on this maritime transit. So it's massive. So if you look at this, the market now faces more than a temporary shipping disruption. Once storage limits force production cuts, the crisis escalates from a logistical challenge to a structural supply shock. At that point, the market isn't reacting to delayed shipments. It's reacting to lost production capacity. Recovery will not be measured in days, but in weeks or months, with tangible consequence for global supply and pricing. So, ladies and gentlemen, that's why you see oil prices pushing where they are. Again, I want you to understand something. Anticipation of the event is worse than the event. The event happened. That's why things are moving higher right now. That's where they're at right now. They're pricing in what happens if this keeps going. So again, I want to keep on going. You may have to rewind all this again. And if you're still here, I'd appreciate a like and subscribe and a thumbs up. As we watch global oil dynamics unfold, it's clear that we're entering a period of acute supply stress. Exports are slowing. Gulf storage tanks are rapidly filling, and producers could face forced shutdown within days. Again, you're looking at millions of barrels per day may effectively vanish from the market, turning what might have been a temporary logistical hurdle into a genuine structural shock for global markets. Again, one striking development is the strength of WTI compared to Brent. When I started on the floor of the Mercantile Exchange getting hit in the head with cars, WTI was more expensive than Brent, when I was 15. Normally, we'd expected Brent to be trading higher, yet the Brent-WTI spread is narrowing during this rally. A phenomena is for seasoned traders and signals unusually market mechanics at play. Ladies and gentlemen, this bottleneck is particularly unique, and it's a unique challenge. Unlike gold, energy markets are exceptionally sensitive to geopolitical disruptions. So you take the Strait of Hormuz, for example. The slowdown there forces producers to keep pumping oil, but with limited export options. Storage is filling fast. Once storage reaches capacity, shutdowns are unavoidable. Although some oil is rerouted via pipelines toward the Red Sea, these alternatives are constrained. It's like trying to push a fire hose through a straw. It's not going to work. The result is a cycle of alternating demand and supply concentrations. Initial disruption caused buyers without immediate need to step back, leaving only those with essential requirements purchasing oil. As a consequence, economies slow marginally, marginal oil demand falls, and storage pressure rises. This is huge. This creates a feedback loop. As storage fills and supply shuts in, the oil that does make it through alternative channels becomes increasingly expensive because those who must have it, military, industrial, and residential buyers, can't stop. Even a partial closure of the strait without full military intervention can escalate risk. Alternatives like military escorted in shipments risk confrontation, effectively raising the specter of broader conflict. In my view, we're already navigating a form of world war, though it's unfolding in slow motion, multi-theater way. The Middle East, Europe, Latin America each represent an area of geopolitical and geoeconomic tension. We've been talking about this. The mainstream media will frame it as international instability, but the dynamics are unmistakably global, ladies and gentlemen. So again, we also talk about the BRICS, the unit, the east side of the tranche, the West, the Treasury, the debt side of the tranche, crypto, everything. You see it happening right now. You see it happening right now. Don't get caught up like sushi. Don't get caught up like sushi. Don't FOMO things here either. Don't chase things. I want to shift focus to precious metals. Yesterday, Venezuela, they basically had a big deal with U.S. gold transactions. Some may dismay it as minor, a mere 1,000 kilograms, but the importance lies in the flow, ladies and gentlemen, the flow, not the volume. Gold had been exiting to the BRICS bloc, is now flowing back under our influence, the USA, mirroring strategies we've executed with oil and silver in Latin America. This is so important. You're going to have to rewind this and write this down. This is not about immediate profit, ladies and gentlemen. It's about securing strategic assets and controlling the flow of resources, a modern extension of the Monroe Doctrine under current geopolitical realities. So from a strategic perspective, these moves disrupt adversarial economies while securing U.S. energy and resource interests. China's oil vulnerabilities, Russia's revenue channels through India, and Iran's continued isolation all reflect the long-term plan. Policies under Trump set this in motion, ensuring that U.S. energy and resource security is prioritized while competitors navigate the fallout. The lens here is not short-term, it's a decade-long strategy. Okay, so again, the oil markets, they have a compelling theory right here, right? So if you look at the WTI Brent dynamic, gold flows, and industrial commodity trends all point to structural shifts. This is so important. This really, really is very important. Gold remains steady. Silver shows strength with its established range, and oil is starting to catch up. So industrial metals like copper are lagging. So for WTI, we may see a return to dominance in pricing, reminiscent of historical patterns when WTI regularly outpaced Brent. So in short term, the interplay supply of constraints, geopolitical risk, and strategic asset flows is creating a high-stake environment. As an analyst, we see this as a critical juncture for energy, precious metals, and broader commodities. Understanding the structural implications now is essential, not just for trading, but for assessing how global markets and power dynamics are evolving over the next decade. Ladies and gentlemen, if you're still here and you want to understand how we're going to take advantage, do come and see us in the Crypto Monthly desk. Again, that's how we capitalize off of the chaos. One thing I learned being a financial mercenary is that we get to take advantage of what Apex benefactors are doing. We're doing what they're doing. That's why I try to give you all these analogies. I'm going to give you the next big one, the next tip. Again, I can't believe I'm giving this away for free. But again, for everybody, one tips from the pitch pays for your monthly membership with us. If you take advantage of that. Again, my point being is this is the next tidbit. But as a financial mercenary, I don't care what side happens. I only care that my benefactors and myself prosper and our bank accounts grow, not financial advice. This is the next situation that everyone's talking about and following, that no one's talking about in the news. And if you want to see how we're going to play this, do come and join us in the Crypto Monthly desk. Again, everybody's welcome, and I love chatting with everybody. This is massive, and this one is dear to my heart. The Gulf disruption threatens sulfur supply for nickel and copper producers. Ladies and gentlemen, this is massively important. Sulfur is used to make sulfuric acid, which is essential for leaching metals from ore in nickel, refining, and copper processing, with some copper producers in Africa potentially facing similar problems. So from my perspective, the unfolding conflict in the Gulf is beginning to pinch a critical supply chain for the metals industry. Sulfur, so important. Nickel refiners in Indonesia, they rely on the Middle East for roughly 75% of their sulfur requirements. So they may have to be forced to cut its output if shipping through this region continues to be disrupted. Again, sulfur is essential for producing sulfuric acid, which in turn is used to leach metals from ore in both nickel and copper refinery. A similar risk is emerging for some copper operations in Africa. So important. So if you look at the degrees of exposure, varies depending on whether producers have access to smelter-generated acid. If you don't have a smelter generating acid, you got problems. I understand this because in our pilot refineries in Indonesia, we've been leaching things forever. So this is a nightmare if you run out of this. And trying to get this in certain countries, sometimes past customs, is even a bigger nightmare. So if you look at it like this, last year, the U.S. Geological Survey reported the Middle East accounted for 24% of global sulfur production, roughly 83.9 million metric tons. So a tanker flows through the Strait of Hormuz, increasingly constrained due to ongoing U.S. and Israeli attacks on Iran. Tehran's regulatory actions and the availability of Middle Eastern sulfur is under immediate pressure. So Indonesia is at the center of this bottleneck. That's home to more than half of the global nickel output. My God, half of the world's global nickel output comes from there. It's massive. I mean, it's massive, and you're not even hearing it on the news. They don't talk about it on the news because they don't want you to be able to take access to this. They hope that you don't pay attention to this. They hope that you're still freaking out about oil while everyone else is gorging themselves on this, feasting themselves on it. They're just feasting on this. I can't even believe it. It's like this, the amount of chaos that's happening right now that's allowing people to take advantage of these situations. It's staggering. Never in my entire career have I seen more unique situations to farm. I can't believe it's like raining. It's raining alpha. I don't even know what to say. It's unbelievable. I don't even know where to start. Well, we can't get off the phones. So again, for everybody who doesn't know, stockpiles at high pressure acid leaching, HPAL, nickel plants are limited. So you're averaging 1 to 2 months of consumption. You only got 1 to 2 months. So sulfur prices already spiked dramatically before that. So I always pay attention to this. So before the current conflict, the commodity accounted for roughly half the operating costs of HPAL plants due to a prior surge in global prices. We're seeing this in miners everywhere. What's happening in their stock price is crazy. Not financial advice, not my opinion, anyone that retains any capacity. So without alternative sources, Indonesian refiners could begin scaling production as soon as next month. Why we say that if things don't get up and running and everyone runs out of the stockpile, it's going to, like I said before, ladies and gentlemen, return to your seat and buckle up. We're about to lose cabin pressure. Again, being the mercenaries, we're going to take advantage of everything we can. Because as everyone takes advantage of all these flows, they're going to flow back into the crypto market. They're going to buy what's on sale and do it all over again. And that's why we're the Remora. If you want to learn how to do this, come and join us. Competition for a limited resource. The supply squeeze is setting up for a global scramble. Nickel refiners in Indonesia, copper miners in Africa, fertilizer producers worldwide are all vying for alternative sulfur sources. Do you understand that you have people who produce all these commodities are fighting over sulfur? They're fighting over it. So even before recent tensions escalated, sulfur traded at roughly 500 per ton. 500 per ton. So since the outbreak of hostilities, prices have climbed another 10 to 15%. So in Southern Africa, available stockpiles are limited. It's unbelievable, you know, and you have areas in Zambia, they have reserves, not very much. Zambia estimates the current reserves around the world where you're getting this, the logistics, 900,000 tons will only last a few weeks. In the DRC, they don't really have as much for their copper productions. It's so crazy. You know, again, I know the names of all these refineries because I've been there, the back of my hand, and it's unbelievable. But that's where the pressure's going. You got to look downstream now, ladies and gentlemen. You got to look downstream. This is what's coming next. LNG, we talked about yesterday. Oil was a week ago. This is what's next. And if you want to know what's going to come after this, please do subscribe, tune in, and join us and take advantage of this. Lions and tigers and bears, oh my. So unbelievable, ladies and gentlemen. You got to understand something, and this is the most important thing. If miners are not self-sufficient with their own smelters, they depend on internal sulfur purchases. They depend on this. So if you don't have a smelter that's producing sulfuric acid as a byproduct when you're leaching, mining, and everything, you got issues. You're going to run out of gas, ladies and gentlemen. So if you look at it like this, and this is what I believe, again, if vessel flows are constrained for more than 2 weeks, this is a free tidbit. If we're restrained for more than 2 weeks, it's going to seem inevitable that the consumption will either need to defer or slow down. So from my standpoint, the combination of tight stocks, rising costs, and ongoing geopolitical disruption creates a high-risk scenario for both nickel and copper supply chains in the month ahead. It's too easy what's happening in the world. And sometimes you almost got to ask yourself, is this being done on purpose for people to take advantage? You know, and again, not conspiracy theory, but you used to see people in Congress insider trading. Maybe people, who knows? You know what? This is something I'm going to make a video on the Patreon because I don't think I can make a video here about this. But again, in my opinion, I'm going to go over all this right now. In my opinion, when you connect the dots across these developments, the Hormuz shipping disruptions, Indonesian nickel sulfur shortages, and structural support for gold, the global markets are entering a period of heightened risk and opportunity. Energy and metal supply chains are increasingly vulnerable. Asymmetric prices are going higher, pressure are building, and macro conditions are tilting towards stagflation. From a positioning standpoint, defensive assets, strategic commodities, and mining equities are likely to outperform if these trends continue, not financial advice. Timing will be key, but the underlying direction of the risk and opportunity is clear. So again, we went over the Strait of Hormuz, oil supply. Oil flows to the Strait of Hormuz have acceptably collapsed, with commercial crossings running at only 10 to 7% of normal. That's left roughly 76 million barrels of crude stranded in Gulf storage tankers and vessels. This disruption is no longer a simple logistical issue. Production shut-ins are already cascading. Iraq has reduced output by approximately 1.5 million barrels per day, and if storage fills and shipping remains blocked, lost production could rise towards 3 to 6 million barrels per day. Alternative export routes offer very limited relief. Pipelines and bypass ports are reduced roughly 0.9 million barrels per day, far below the 3 to 4 million barrels per day potential capacity. The asymmetry in market risk is clear. So your reassessing headlines may shave off $10 of prices, but actual Gulf production shut-ins could push Brent roughly $30 higher. If you're still here, you're going to get the best parts now, ladies and gentlemen. If the disruption persists, Brent could exceed 100 per day barrel in the day. It's going to, I don't know, ladies and gentlemen. From our tips in the pits, we're looking to get out at 102. We've been taking profit from when we got in the low 60s. Again, the peaks observed in 2008, 2022. Again, Indonesia's nickel refineries supply bottleneck. The Gulf is disrupting, is now spilling over into critical metal supply. Indonesia, which produces more than 50% of the world's nickel imports, 75% of its sulfur from the Middle East. They got problems. Sulfur is essentially for producing sulfuric acid, which in turn required for high pressure acid leaching. HPLA, my favorite, nickel refining and similarly for copper extraction in Africa. HPLA plants in Indonesia typically maintain only 1 to 2 months of sulfur stock. That's why I couldn't get off the phone. I've been on the phone nonstop with people looking to source everything. People are trying to get what we have left over. It's crazy. It's crazy. With prices already elevated, accounting for roughly half of HPLA operating costs before the conflict, plants could be forced to cut production as early as next month. We're going to see shocks in prices all over the place. It is a smorgasbord of what's happening. People getting cut up like sushi. This is just, it's unbelievable. You're going to have to make a list of all these things. Trying to take the PhD or PhD. A scramble for limited sulfur supplies is emerging. It's pitting Indonesian nickel refiners against copper producers in Africa. That's the big thing I'm going over in the Patreon. I'm going over where when there's an argument between producers, where there's not enough sulfur, you got refiners freaking out. Is copper more important than nickel? Who knows? We take advantage as much as we can, not financial advice. In Africa and fertilization manufacturers globally. So think about that. You got people fighting over fertilizer, copper, and nickel. Who gets the sulfur? I don't know, but the prices are going to go higher. Some copper miners are insulated because they have their own ability, like the ones that we run. We have our own ability to make our byproducts. But again, you have some who are so heavily dependent on Gulf sulfur. It's unbelievable, so that's the big thing. And again, the gold and macro positioning amid these supply shocks. Gold continues to demonstrate structural support, geopolitical risk, ongoing central bank accumulation, and doubts over the durability of fiat currency underpin the market. From my vantage point, timing and direction is the most important variable. Movements in liquidity, real interest rates, and investor positioning will be likely the drive to the next leg major higher. The gold mining sector offers leverage exposure to the environment. Elevated prices combined with disciplined capital expenditure are improving margins and free cash flow while investors' position remains undeveloped relative to macro backdrop. There's clear room for reallocation towards gold and related equities of geopolitical supply-driven shocks. So if you look at broader economic implications, energy-driven supply shocks tend to push inflation higher initially, while over the medium term, they slow growth as costs ripple through supply chains and consumer spending. The resulting environment often resembles stagflation, rising inflation expectations paired with slowing economic activity, which can disrupt traditional asset correlation and favor defensive positioning. So central banks are likely to maintain a cautious wait-and-see approach. The supply shock driven is crazy. So it's making aggressive tightening politically and economically difficult, even as inflation pressures rise. So regionally, energy exporters and defensive U.S. assets are likely to remain resilient, while exporting energy economies and cyclical equities are facing the downturns. Key takeaways of everything we just went through: Oil, Hermes disruption could push Brent above $100 quickly. In my opinion, not financial advice. Alternative routes provide minimal relief. Nickel and copper, sulfur supply constraints threaten production in Indonesia and parts of Africa, creating price and output pressure. Gold and macro, structurally supported by geopolitical risk and central bank demand. Mining sector margins are improving, providing leverage exposure. Market policy stagflation pressures are building a defensive position, and cash are likely to outperform while central banks remain cautious. So from our perspective, in my opinion, the next several weeks will test the resilience of energy, metal supply chains with clear implications of global prices, investor positioning, and macro policy. Those who position strategically across these interconnected markets will likely benefit as volatility, asymmetric risks continue. Ladies and gentlemen, this content is for informational and entertainment purposes only and should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. If you made it this far, ladies and gentlemen, I salute you. Well, I talked about the Moscow situation with XRP. Think about it there. Moscow's being allowed right now to help oil in India. You can see why we're in the camp that XRP needs regulations, and we believe things will get done. But as you see the world changing right now, there's so many things to take advantage of. It's like Harry Houdini. He can make something disappear in front of everybody because of diversion. There's so much happening right now. It's unbelievable to take advantage of. It's unbelievable. But again, this is no more than the BRICS again and the unit against the West side. They drew first blood with what they want to do with gold, HQLA, and you can see the response again. If you go back and rewind this, you have a lot right here. And if you want to see how we're going to take advantage of all this, again, we went over LNG last time. I just gave you where we're going next. And again, I was on the phone with a family office. I've worked forever. And they said, I'm very much like a financial privateer. I said, that's what a financial mercenary is. We are financial privateers, but you're all benefactors, and I'm my own benefactor. So everybody who packs up with us, we're doing this for ourselves and learning of our own family. This is, as far as I'm concerned, if you made it here, this is a once-in-a-lifetime current event. What's happening with all these situations around the world, and there's more and more coming, and it's going to create a domino effect of the ability to take advantage of situations. Again, this is all I do. I'm designed for this, and I love teaching this to everybody who is joining. I do, because to me, this is all I know, and it's super exciting. It really, really is. So it's what a time to be alive. I don't care what happens. I just care of taking advantage of every situation. Because in the end, when all this drama calms down, because it always does, people are going to buy the most inexpensive item, which will be crypto. So crypto's getting on the chin. Crypto's the ultimate risk-off play. And if you're still here, you can see this. I salute you. Don't get caught up like chum. Remember, ladies and gentlemen, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves they'll never let it happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet. Right into the moment, they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. If this opened your eyes, smash that like button, ring that bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic, where we break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I love you all.